It says I'm live, so I guess I'm live, and I thought I would come in here and do a live Q&A. There's been a lot of questions that I've been receiving since I started producing all of these videos on my channels. So I've got the TikTok account going well. I've got the Instagram account blowing up lately, and obviously I'm recording this in YouTube as well. So you guys are in one of these platforms, start asking any questions you want. But what I'm going to be doing initially is just going through some of the news that I've seen in the market. I track the property investor news, like anything that I see that I think is going to impact the market. I tend to sort of keep an eye on that, track that kind of stuff, because I see it as something that could impact the market. Anything that could push up prices, that could push up borrowing costs, that could increase the demand, increase the supply, anything like that, I sort of tend to pay attention to. And I'll usually talk about it in the mastermind that I have. And you can obviously learn more about the mastermind if you check out my bio or whatever. But the first bit of news that I've seen today, it was actually in this morning's Irish Times. It's kind of like front page news. Is there's an estimate from the Central Statistic Office that you're looking at 7 million population here in Ireland predicted or projected, certainly by 2057. Now 2057 is what? It's 26. It's like, you know, it's a generation away, but 7 million people in a generation is huge. It's absolutely massive. And we already are on the verge of collapse in terms of our housing system. So you kind of wonder, like, how is this going to work? There's just going to be so much housing needed. It's going to be constant for the next 25 years, constantly required. And there's always going to be pressure. If you're looking at 7 million people by the time you get to 2057, you're looking at probably needing to build something like 50,000 houses every single year for the next 25 years, consistently inside, you know, day in, day out. And the systems that we have in place just don't permit that at the moment, like in terms of planning and things like that. So I think you have to, you just have to assume on that basis that we're looking at many, many, many years of a housing crisis. And I know people talk about, you know, they're going to fix it and all this kind of stuff. I just don't know how they are going to fix it. I see so many comments. Anytime I put a video out there and I'm talking about this, you know, I'm not like taking sides. I'm just simply stating my opinion. And the fact is that the construction sector is already pretty much at capacity. If you ask anybody to do a job for you at the moment, it's always, you know, Jesus, we'll see if we can fit you in. There's almost never guys that are lying idle with nothing to do. And so that being the case, construction sector flat out. We're currently building 34,000 housing units a year. And if you're building 34,000 housing units a year here in Ireland, that represents about, you know, we'll say ballpark figure, about 30% of where we were, maybe 40% of where we were back in 2008. And so that's, you know, 15, 16, 17 years ago. It's a long time for us to be at a fraction of what we used to have in terms of capacity. Back in 2007, I think it was the peak when we built something like 85,000 housing units that year. And the problem is that the population didn't support it back then. And so there was a massive oversupply, and everyone that was buying, they were buying because they were speculating on there was going to be an increase in prices. You were going to be able to sell it for a profit. And therefore, of course, why wouldn't you buy it? It was easy to buy because the banks were lending money very, very easily. Not like today, by the way. I mean, anyone who's trying to get a mortgage stuff now, it's very, very, like there's a lot of hoops that you have to jump through. And so you have to think about this from the point of view of, so construction is constrained. There's no way that we can, like there's so much demand. If we wanted to, we could go from 35,000 housing units a year to 50,000. That is, the demand is there for that, like straight away. And so why wouldn't you do that? You wouldn't do that simply because it's not possible. But the money is there. The ability to do it is there. The profit would be there. And so anybody who could do it would be doing it. But there just simply is not the ability to do it because the capacity of the sector is. You've also got all these kind of planning hurdles. People are trying to get planning and then they're being turned down. The system is very, very slow. I've talked about how the system is very inefficient. I mean, different county councils may be different, but certainly the one here in Dublin, if you want to submit any kind of a large scheme, you cannot do it electronically. You have to do it there in paper. You have to actually physically show up and hand it over a desk. And in this day and age, when we're talking about AI and all that kind of stuff, you kind of wonder, like, is that the best that we can do? I saw today in the papers that they're talking about that the motor tax, you'll no longer need to display a tax disc on your window because they will have all of the data basically tied to the reg number on your car. And so, well, there's some progress, but this is stuff that probably could have been done years ago. The technology has existed for years. It's just a matter of why aren't we doing it? And so you wonder about this stuff. When you just wonder, like, how are we as a nation going to deal with this crisis if we can't adapt quicker than the way we are at the moment? We have a planning system that's kind of crumbling at the seams. It's just not capable of delivering quick enough. We have a construction sector that just cannot grow quick enough. And why is that? The only way you could grow the construction sector is if you had more sort of tradespeople and more laborers. And there isn't enough of them in the country. And so you say, oh, that's easy. We'll just go and bring in a whole load of them from, we'll say, Eastern Europe or wherever, some part of the world where there's an abundance of them and they're looking for work. And you say, guys, there's tons of work over here. Come on over and let's do that. And the problem with that is that where would you put them? Like, we already have a housing crisis as it is. We already have got, refugees filling up every single square inch of the country that we can find. And so where are you going to find, if we decided to bring in an additional 50,000 tradespeople and laborers in order to kind of boost our capacity for our construction, where would they be accommodated? They just wouldn't be able to be accommodated. There's not enough schools as it is. The medical system is crumbling and stuff. So there's not going to be an ability to grow the construction sector anything more than the smallest, like, incremental increases. I can't see them saying, okay, we've gone from 34,000 this year to 50,000 next year. It's just, I don't think it's possible. So that being the case, I think we're in for a long period of basically just having massive, massive demand and just no supply potentially no supply to actually accommodate all of the demand. The demand is going to start increasing now. Reading that headline, 7 million population in the country by 2057. Think about that, 7 million. That's like, we're talking about an additional 1.8 million people. That's a 35% increase on the current population. And when you think about that, you kind of go, Jesus, like, already we're crumbling at the seams. How are we going to accommodate this? And so that is the reason why I am bullish on housing prices and things like that. Like, I see questions coming in on the feed and I see people asking me in the DMs and stuff, for a bit of advice. Say, Gavin, I'm looking to buy a house, but I'm just wondering, should I hold off? And I kind of say, hold off for what? Like, if you hold off, are you thinking that there's going to be a crash and that you can buy cheap? Because I don't think that's likely. I really don't. I think, if there is a crash, I can't understand what would be the trigger. Now, that's not to say that there may not be, because there is, I've talked before. If anyone who's familiar with my content, you'll know that I talk about the 4 E's, and those are the things that can actually take you down as an investor in this market. And the first one is your ego. Your own ego is usually a big cause of problems as an investor. You invest in a property and it starts to go really well, and you start thinking to yourself that you know everything, that you're really, really, you're hot shit. And sure enough, then something happens and you realize that your ego was a little bit inflated. Maybe you were overconfident, and that kind of thing has happened before. I've seen that. It happened to me. I got way overconfident back in my kind of 30s. I started making a lot of money in property. I started I had this run of luck where every deal I did was just doing so well. And one of the deals was really good deal. It was like 2.5 million profit in the space of like 2 months. And when I did that, I can remember just thinking to myself, wow, I'm on fire now. Like there's no way I can do any wrong here. I figured out what the secret code is for making money. That's what I thought. And sure enough, 2008 came along, and boy, was I humbled for having that kind of opinion. And so it just shows you what can happen. Let me just get the mic into the right place. So the next thing, you might hear my puppy in the background there trying to get into the room. So demand is going to go up. Supply cannot be fixed. And then you're in a situation where the planning system, all of these kind of constraints, there isn't enough accommodation to bring more people in to increase the capacity. And you've also got all of the kind of the difficulties that are going on in the market. Now, I can understand there's a lot of unpopularity. Like if you say you're a landlord online these days, get ready for a whole load of abuse. Now, I think it's misplaced. I don't think landlords deserve the abuse that they kind of get. It's amazing like how brutal people can be. Like it's water off a duck's back for me, but I have people accusing me of being a slumlord because I have an opinion on the housing market. And I kind of just, I'm not even renting property directly myself. Like I'm not even a landlord anymore. I'm a landlord in commercial property, but I'm not a landlord in terms of housing and things like that. I don't rent out to individuals. And so that being the case, I don't deserve the abuse, but you get the abuse because people are so frustrated out there. They hate the idea that they can't find a property that they want at a price bracket that they want. I get it. It's very understandable frustration that people are going through. But the reality is that landlords that are out there are not making hand over fist money. What a lot of them are simply people that are trying to plan for their retirement. And I get a lot of messages from people on the DMs to me and stuff like that. Gavin, I need some advice. I'm looking to plan my retirement. And you kind of think to yourself, well, you can go and put money into a pension, and the pension will go and buy stock market shares and all that kind of stuff. And you can do very well on that. But a lot of people that are in the trades and things like that, a lot of the time there will be a kind of a suspicion or just a sense that, you know what, I don't know anything about the stock market, and therefore I don't want to put my money in the stock market. I would much prefer to put it into property because I understand property. I'm able to buy property. I'm able to understand how to repair it. I'm able to rent to somebody. It's not rocket science. It's not complicated. Whereas if I give my money to a pension fund, they're buying shares, they're selling shares. I have no clue what's going on. That's the mentality. And it's understandable. So people want to invest in something that they understand and that they feel they have a handle on. And so the vast majority of people that are landlords are just guys that are maybe, the electrician, the plumber that's out there. He's making a good living, but he's thinking to himself, a couple of years from now, I'm going to be hitting 60. I don't want to be in my 60s trying to, continue to work as a sparky or as a plumber or whatever it might be. I would like to have a property that's producing an income in the form of rent. And that's going to be my pension. And that's simple. That's the way a lot of people are thinking about it. And I can understand that. And so that's the reason why people go out and buy property. It's not because they want to dominate the market and they want to. The vast majority of landlords that are out there only own 2 or 3 properties. And if even 2 or 3, sometimes I think there's 1 or 2. And so that's the vast majority. Now, having said that, there has been a complete exodus in the last year or so. I was looking at the headlines today, and it says that what was it now? I just found it earlier. It says that there have been a drop of over 20,000 tenancies in the last 12 months. And this is figures that are coming from the RTB itself. So this is not speculation about the numbers and stuff. This is the number of registered things that are actually out there, registered tenancies in the RTB, it said it's fallen by 22,474 on the previous year. And it's basically guys just getting out of the market because they're fed up with the way that the system is. There's this rent pressure zones where if you are renting a property, you're not able to raise the rent to the market rent. You just have to keep it at whatever your current tenant is paying you. You're only able to incrementally increase above that level. But what happened is, and this happened to me, I was renting up until a couple of years ago before I bought. And I had a very, very nice landlady. She used to rent the property to me. And I lived there for 5 or 6 years. And in the 5 or 6 years that I was there, I never had an increase in rent. She never asked for a penny more. So very nice lady. I was very grateful for it. If she had, she'd be entitled to go and increase it by a couple of hundred every year, whatever it was. And she didn't. And so 5, 6 years later, I moved out of the property into my own home. And she basically, she goes and she decides, let's go and put this property back on the market and put it out for rent. And she is not able to now increase to the new level of the market. She must increase it based on the level that I was at. And I was only at I was at the same low figure for about 5 or 6 years. And so by that lady being nice to me, she's actually kicked herself in her own leg, basically. Is she's not able now to increase her rent. Like if I was paying 2,000 a month, she should have increased it every year over 5 years to maybe 2,500 or whatever it might be. And she didn't do that. And so as soon as I moved out, she could only increase it by 2040 or whatever it might be. And so she basically, by being nice, she screwed herself. And so that is one of the problems. All of these rules just make it very, very difficult for people to have a property that makes sense. Just to collect the rent, to all of these rules and regulations and stuff. A lot of people just find it's just gone too far, and so they're getting out. So over 20,000 people have left the market, and that's 20,000 less tenancies. Now, so you might have a house that's rented out to 2 or 3 people. So maybe there's 7,000 landlords have left, but that's a substantial number of people that are no longer renting that were previously renting. Now, they might have gone and bought, and so that's good. But the fact that if they had bought and the property was taken off the market temporarily and then put back on the market for somebody else, then that would balance that out. But the fact that 22,000 has been lost means that the person sold the property probably, and so maybe it was somebody who bought it to move into it instead. So you have the same number of tenants out there, just 22,000 less properties for them to rent. So it says a lot about the way the market is going, and it's one of the reasons why I just think it's going to continue to be high prices. To buy a property, you've got so few properties for sale and so many people chasing them. And therefore, it's going to be nigh on impossible for you to get a good deal. You've got to go out and really, really search high and low to find a good deal. Maybe you'll find one if you're lucky, but the vast majority of people put properties up for sale and they give them to an agent. The agent will advertise it. The advertising will be seen on the newspaper, or it'll be on Daft, or it'll be on myhome.ie. Everyone sees it. And so everyone goes and bids on that property. There's very few people that say, you know what, I don't want to go and give it to an agent. I want to sell it privately. I'll put a little sticker on the window that says for sale, and a handful of people will see it, and I'll deal with them when they come to me. If that's the case, then maybe there's a chance that you'll get a good deal there. But it's not in the person who's selling's interest to do that. That's for sure. Now, you as a buyer might be delighted that that's the way that this person has gone because you have a crack at it. And so that is the way the market is at the moment, and hard to kind of see how it's going to come out of that. Now, I have a mastermind, and I talk with these guys every week on this topic, and we've been looking at the headlines, and every week there's a new headline about the housing crisis. And a couple of weeks ago, there was a headline from the ESRI. Now, that's the Economic Social Research Institute. And they're one of these kind of economic think tanks that come out with all of these messages on the way the market is moving, and they make recommendations to business and stuff. They have said that at least 35,000 new homes and perhaps up to 53,000 new homes will be required every single year to meet the demand that's currently in the market. Currently we're building 34,000. So we're already, below the level that this recommendation is the lower level of what they're recommending here. And the upper level, we're miles away from that. We're like 20,000 away from the upper limit. Now, not so long ago, there was another one. A report came out. I think it was maybe Davy Stockbrokers or somebody, and they were estimating that 85,000 houses are going to be needed. And so when you see these kind of figures, like, first of all, there's no consensus. Like, there's all sorts of, and the reason that you can't have consensus is because people will have different hypotheses around what the market's going to do. Like, if you take the last 18 months as an example, what we're looking at is, massive influx of people. Now, of course, a lot of that is to do with the war in Ukraine and the fact that we had a huge number of refugees come into the country. So you could say that last year was an anomaly. 2022, 2023, a bit of an anomaly, not likely to continue like that. But that betrays the actual figures. If you go and have a look at the figures, there was 140,000 people came into the country. Only 70,000 of them were refugees. So the population increased by another 70,000 more than what we were kind of expecting. And so that is that's one of the issues that you have, is that a lot of people will have different opinions about growth potential and prospects and stuff. And you don't know until you see, the numbers of people that arrived into the country. Another thing, and this is one of the comments from one of my mastermind members earlier today, we had the call about an hour ago, and he was saying that there's estimates from the projections from we'll say retailers like Tesco and stuff, is that, and they know based on the number of products that are being bought through their shopping centers, they can estimate what the population is, and they believe that it's substantially more than the Central Statistic Office estimates. And that is because we put out every couple of years we put out a census, and it's everyone's duty to fill in the census and put in how many kids are living in the property and all that kind of stuff. And that's all fine and well. But if you're an illegal immigrant that's living here, you're not filling that out. Or if you're somebody that is on a work visa that's about to run out or something like that, you might be thinking, I won't bother filling in that. So you can imagine there could be a substantial number of people that are either suspicious that it could be problematic for them if they fill it in, or are simply not sure what they're going to do in the next 12 months and just decide, I'm not going to fill this thing in because I'm not sure, will I still be here, or whatever it might be. Sometimes people simply don't understand what the purpose of the census is. They think maybe the government is trying to kind of like catch them out, and that if they don't have their paperwork perfectly in order, maybe I shouldn't fill in this thing just in case it leads me to end up getting deported or something like that. So there could be maybe an extra 100,000 people that are there that are just not according to the Central Statistics Office figures. And so we don't even know how many people are in the country. We have this estimate at the moment that it's 5.2 million, and they're estimating it's going to grow to 7, which would be a 1.8 million increase. That is very high. And think about the number of homes we're producing. We're producing 34,000 housing units a year. And we're talking about an extra 1.8 million people. Now, if the average, housing unit accommodates, we'll say 2 people, then you're talking about 900,000 needed. And we're building 34,000 a year. So give you an idea of just how many are going to be needed just to keep the level where it's at today. Nothing to do with oversupplying the market. If you were to oversupply the market, then there was a chance that you could reduce prices. That is what brings down prices, oversupply. And it looks like for the next 25 years at least, that we are going to be undersupplying the market. And so what does that do? Pushes up prices. If 22,000 less tenancies are here in this market today than there was 1 year ago, what does that do? That pushes rents up. And so, you can see the way it's moving. Now, what could cause this? What could cause a disruption in the market? What could, create some sort of economic uncertainty? That could well be Donald Trump getting into power. Maybe that, makes the world global economic markets kind of wobble a bit or something like that. Who knows? I talked earlier about the 4 E's, the things that could damage you as an investor. Your ego was the first one I mentioned. The second is your emotions. Now, your emotions, we are emotional beings, and we are quite capable of worrying about things that may never happen. People have anxiety. People worry about what's going to happen in the future, and so they worry about stuff. Also, you get upset, you get angry. All of these emotions can actually badly impact your decision when it comes to investing. And that's one of the reasons why property sometimes can be a better investment than, say, the stock market or crypto, because people are so emotional. I remember I was investing in property heavily, and I had all my assets were basically property. And I can remember thinking to myself, I'm so overexposed to property. I should really diversify, and I should get into the stock market, and I should have a lot more investments in stocks and shares and things. So I went and I did it all the wrong way. I used my ego got carried away. I thought to myself, I know what I'm going to do. I'm going to be one of these day traders. And so I got the 3 screens with all the shares going up and down and all this kind of stuff. And I started buying and selling shares. And it went really, really well for a while. I made a lot of money in a couple of months. And then suddenly it all started to go kind of pear-shaped. And in the period of time that I started losing money, I can remember it was all because of emotion. You buy shares and you see that they've gone down a little bit the next day, and you're like, oh my God, I got to sell out of this. And that's emotion. At least with property, the benefit of property is that you kind of set it and forget it. You just leave it there, and you're not watching a share price going up and down on a daily basis. And that at least saves you from that. A lot of people, just when they see the shares going up and down, they think, I better sell. And then the next day, it's bounced back up again. And you can see the amount of people that got into crypto and they bought it at 70,000 and it fell massively. Those guys all got burnt. But then the people who bought low and it started to rise. I can remember I had a friend who was into crypto way, way back before anyone even talked about crypto. This guy knew all about it. And it was 2011. And I was living in the south of Spain at the time. And I can remember we had a barbecue. We were talking about crypto. And I was like, what is crypto? Nobody had heard of crypto back in 2011. And it wasn't even crypto. Nobody had even heard of Bitcoin. And I can remember him talking about Bitcoin. Bitcoin is this new cryptocurrency. And I technology and innovation and stuff. So I was like, tell me more about this. I want to know more. And he explained, and we agreed around the table. There was a bunch of us there, and we were all investors. And we said, why don't we all chip in 4 or 5 grand each, and we'll go and buy a load of Bitcoin. The price of the Bitcoin at the time was 91 cent. Or 90, no, sorry, not cent, dollars, 91 or $92. And I can remember thinking to myself, wow, $92, okay, yeah, I guess why don't we all go and buy 5 grand's worth, and we'll have a little fund together. And anyway, that was on Saturday during a barbecue. And then a couple of days later, it was the stock, we decided, let's go and actually go ahead and buy these shares or these units in crypto. Let's buy these Bitcoins. And so we called up, he went into the market, and he came back and he said, guys, the price has gone up substantially since we were talking about this. It was 92 when we talked about it on the weekend. Now it's 141. Will we go ahead? And most of us, we had no clue what we were doing. We sort of thought, God, it's gone from 90 to 140. That's a 50% increase. The thing could fall by 50% by next week. And so we decided, nah, let's just not go ahead. We just don't understand much about this, and so leave it. So if we bought that at 92 or even at 141 and held on to those shares or those Bitcoins up into 70,000. Like, I've done the maths. It's like a couple of million. A 5,000 investment would be worth a couple of million. Now, do I beat myself up over that lost opportunity? No, because I know as emotional beings, what would have happened is that we would have bought at 140 and you would have sold at probably 300 or something, thinking you're a genius. Or maybe you thought, you know what, I'm going to hold, and you sell at 1,000 and you've 5x your money. You're a genius for 5xing your money. Almost nobody would have thought to hold on until it went up to 50,000 and 60,000 and all of these levels. Like, it just wouldn't be done, because you're looking at massive fluctuations over that time period. And the shares went up to 16,000, then they fell down. Then there was this period when I think it was Mount Geox, when there was this attack and loads of people lost their crypto and stuff like that. There was all these ups and downs. People are emotional beings. They just would have got out of it when they kind of went through that kind of experience. The next E that can really damage you is the economy. And we buy and we sell things in the economy, and we assume that the way it's going at the moment is the way it's going to continue going. And so that is what's known as a continuity bias. And most of us as investors, we suffer from a continuity bias. And that is the current state of affairs that you're living and experiencing today. You assume that's the way it'll continue to be tomorrow and the day after and the day after. And so if you're going through a really difficult time, you tend to believe that it's going to continue to be difficult. And that being the case, you decide not to invest. If you're going through a really, really great time and everyone is making loads of money, you think that it's going to continue to be a great time. And so you tend to invest in that situation. And of course, you overpay and then the market crashes, and you never saw that coming. So that is the reason why the economy can really grab you, and your emotions can kind of get in the way. And the final thing is events, the final E. And your events are the stuff that nobody can predict, that comes out of the blue. COVID was an event. Nobody saw it coming. Like, you heard about it in January, and by March we were all locked down. Like, if you think about it, I can remember sitting down in December 2019, and we were starting a new decade, and we were going into January 2020, and I was making plans saying, okay, this decade is going to be the one that I really, and 3 months later, the whole world is turned upside down. And so any plans you made, just out the window they went. So it just shows you that events can happen. Back in 2001, 9/11, September 11th attacks in New York City. That was something that created an event, and that reverberated around the world, and the stock markets all sort of collapsed for a couple of weeks and things like that. 2008, the collapse of Lehman Brothers, another event. All of these things create these sudden frights in the market, spooks the market. Everyone wants to go head for the exit. Nobody can get out fast enough, and so the prices drop dramatically. The only time to buy, like, people that are brave enough to do that, they pile in those moments. They're the ones that do really, really well. That's called having a contrarian mindset, but not everybody does it. So guys, that is the first part of today's talk. It was really just a bit of a commentary on the market. Now I'm going to answer some of your questions. And I know we got a few questions. I have a free community. For those of you who are watching, you may already be in the school community, but if you're not, you should find a link down below somewhere in the comments or in my bio or whatever. There'll be a link to the free school community. And in there, I'll be posting the link to this video if you want to watch this afterwards. But what I'm going to be doing is, I posted during the week that I'm going to be having this Q&A, and I asked people to post any questions that they had. So we have a few questions I'll be going through. And also I got a question from somebody, from a James in Instagram, sent me a question earlier. And this is the one that I'm going to answer first. And then I'm going to have a look at the comments that you guys are making and see, are there any questions that I can answer? And I have, just so as you're aware, so I'm looking at TikTok on this camera, I'm looking at Instagram on this camera, and I'm looking at YouTube on this camera. So I've got 3 cameras set up. So if I will get to your question, hopefully, but the best place to put your question is in the school community. because that is the one that I'm prioritizing. So if you're in the school community, drop it in there. Look for the thing. It says live Q&A session starting Wednesday. I'm going to be doing this every Wednesday, by the way. So guys, if you want to put this in your diary, every week, same time, I'll be doing this Q&A. And so I can answer your questions. But James asked me a question, and he said that he's just gone sale agreed in buying a property. And he wants to know, should he go fixed or variable on his mortgage? And this is a really difficult question to answer because it all depends on your mindset. Like, it's very hard for me to tell you some advice, but I can tell you what's happened to me in my experience, and I can tell you what is likely to happen, and I can tell you the pros and cons of both approaches. And so we're currently in a situation where interest rates are much higher than they were. So if you remember back to 2020 during the COVID thing or whatever, interest rates were at zero effectively. In fact, they were they were below zero. And so anybody who had money over a certain amount of a deposit account in the bank, you had to pay interest to the bank for them holding your money. It was a negative interest rate. We've gone from that, and then obviously COVID happened, and then the cost of living went up and inflation grew and everything like that. And the way that the central banks combat inflation is to increase interest rates to try to cool the economy. And so that's what's happened. So we now have much, much higher interest rates than we did 3 years ago. But the thing is where are the interest rates going is the question. And if you're in a situation where and what you should do, you need to do your own research on this. And there's a lot of research that can be done. But if you just go into Google and type in ECB, the European Central Bank, and then type in consensus rates, interest rate consensus for the next 2 years or whatever, and you're bound to have Bloomberg and all of these different people putting out their opinion on where the market is going. And I see another comment in there, so thank you for that. I'll be answering another question there. But this consensus comes in. There is no consensus, by the way. If you have a look at, there's charts that show all the different opinions, and some people think that interest rates are going to start falling very rapidly. Other people think it's going to be much slower. So it really doesn't matter like what you think. It's going to be what happens. But there's a lot of people that believe it'll be quick. There's a lot of people that believe it can be slow. It really has to be, what do you believe? And of course, nobody's sure of what's going to happen. But you need to think about your personal circumstances and what suits you. Now, what I can tell you is that if you want to fix at the moment, what you will be doing is you will most likely be offered a better rate because it's fixed. And you'll be told that you're fixing your interest for the next, we'll ever say 1, 2, 3 years, whatever it is that you choose to do. And the rate will stay at the very same. So from the point of view of your mindset, maybe that's a good thing. It's a good thing. Why? Because you have some certainty of what your monthly payments are going to be for the next couple of years. The problem with that is that interest rates could fall. Like, the consensus is that rates will be falling over the next while. When exactly there's no consensus around that, but the general consensus is that they will start coming down. So if you've locked in and fixed your rate today, there's a strong likelihood that the rates will fall and you'll still be paying the higher rate at some point in the future. So that might feel painful and that might be irritating if you locked in and the rates fall very quickly, because you'll be paying that high amount for much, much longer than you maybe wanted to. Having said that, if it takes longer for the rates to fall and if it's a much slower kind of fall, then you'll probably be fine, because usually there is a bit of a spread between fixed and variable. And if you decide to fix today, the likelihood is, yes, you're locking in, but you're locking in at a lower price than what the variable rate is. And if the variable rate, is slow to fall, then the likelihood is that you'll actually be doing better than the variable rate for a longer period of time. But who knows? Like, this is the thing. Now, what can happen is that you decide, you know what, I'd like to wait on the variable rate and just see what happens with the market. And then when it goes a bit lower, then I'll jump into the fixed rates. That's what people sometimes think that they'll do. And that's how I was looking at it. I can remember back in 2005 or 6 or something, I had a big property paying me a lot of rent, and I had a big loan against it. And the interest rate was the difference of, tens of thousands a month in income for me. If I was to fix, I would lose that huge benefit. And so I can remember thinking to myself, there's no way I'm fixing and giving up that advantage. So I decided to leave it variable. But then over a period of, maybe a year and a half or something like that, every quarter or so, the ECB would meet and they would say, you know what, the economy is heating up. We're going to increase the rate a little bit, and it would go up. And the amount that I was benefiting would just reduce ever so slightly. And then it would happen again, another increment down. And it got to the point where I can remember I was now on a variable rate, and it was coming down to nearly zero of a benefit to me. And suddenly I thought, you know what, I should fix now, because there's no advantage to being variable, but I have the risk of it going negative on me. And so I'm going to go and try and fix now. And of course, when I looked at the fixed rates, by that stage, they had gotten much, much more expensive. And so suddenly the cost of me fixing was going to be actually having to pay in interest every month. And so this is the thing. It's that the banks tend to have an opinion on the way that the mortgage rates are going to go. And they'll have all these economists working in their different departments and stuff. And they'll have these projections saying the rates are going to go and do this over the next year or this over the next year. And they will go and they will adjust their rates, their fixed and variable rates accordingly. And what they're trying to do is they say, if the rates are falling, well, then what they'll do is they'll encourage everyone to fix, and they'll disencourage you to go variable, because rates are falling. They want to prevent you from doing that. If, on the other hand, rates are going up, what they'll probably do is they'll leave everything variable, because they stand to benefit from you being on the variable rate. As it goes up, you'll be stuck and you'll have to pay the higher amount. And so that's the way it is. So does that answer your question? It doesn't. All it does is lets you know what you need to be thinking about. And what a lot of people will just do is, you know what, I don't like not knowing what's going to happen in the future. I don't know. Like, I like the fact that I know what I'm paying every month, and therefore I'm going to fix. Or you might be a person who has a greater tolerance for risk, and you're saying to yourself, you know what, maybe I'll pay a price, but I'd actually like to play that, play that card, or take that gamble. Like, at the end of the day, if you're buying property, it can be a gamble. Most, don't ever assume that prices are guaranteed to go up, because that is the rock that you'll perish on. I always bought property thinking it can only go one direction. And like, it did for many years, but then it stopped and it went down very sharply. And that was the bit that was really, really painful, is because when your whole economic outlook is around growth, you tend to go and do things that are silly. And you might go and overpay for a property thinking, well, you know what, the market's probably going to correct that anyway, so no big deal. Sure enough, 2 years later, you're looking at negative equity and you're in deep shit. And so that happened to me, and therefore I'd be careful. Fixed, variable, there's pros and cons to both of them. Have a look at your own mindset and just understand, what is it that, if you can tolerate paying a fixed rate for the next couple of years, well, then go with that. If you'd like to kind of throw the dice and hopefully end up paying less in 6 months' time, then go variable. But there's really no guarantee either way. Right, let's go to the next question. The next question I have here is from Niall. And what's the best way to go about accessing a piece of development land prior? Is it assessing a piece of development prior to purchasing, considering the inconsistency of local authority approvals and the weight of some objections and stuff? Well, look, when people are looking at buying land, they have to be development. The development business is a risky business. There's all sorts of components. Like, if you're just buying a property to rent, that's far less risky than buying a piece of development land that you're going to build on, because that introduces a whole load of additional issues that you have to be careful about. What I've seen when I buy a piece of land is that, first of all, is it zoned for what you want to do? If you are thinking that you would like to build, we'll say, a couple of houses on a piece of land, first things first, is it zoned to allow you to build houses? That's the first question. After it, you find out that it is, like, what you want to make sure is that it's not agricultural land or green belt or something that is not zoned for what you want to do. First thing. Second of all, and you can do that by going into the local authority websites. They will have maps. You just go into whatever your local authority is, go in there, go to the planning department and have a look at the zoning maps. And you'll see all these colors representing an area. And you just zoom into where the land is, and you'll see that it's colored a certain color, or it'll have like hatched lines across it or whatever. And look at the legend, and the legend will tell you this land is zoned for whatever it's zoned for. That's the first thing. Let me just get a bit of water. Next thing is it serviced? And by that I mean, is there water? Do you have like mains water, or do you need to put in a well? That's the first thing. Do you have access to the sewer system? Is there like mains sewage? Is there like a central sewage system, or are you having to build a septic tank for the house? Both of those will put a cap on the amount of development that you can do. If you have a property that is on a septic tank, like, the likelihood is you'll be facing some resistance to what you can build on that, because it only has a capacity of a small amount of capacity. And so maybe if you're a local living there and your family live there, you'll be given permission. But if you're a developer thinking that you can build there, I'd say it's highly unlikely. The next thing is power, like power and gas. Like, gas obviously is less of an issue now in some parts of the country, but electricity, like, is there electrical services in the area? Is there a substation that you can take a feed from? All of that stuff is important to know. Is the capacity there for what you want to do? And Irish Water, obviously, I talked about that. Gas, like, for example, I owned a house in the city centre here in Dublin, and it had a gas connection. But one of the other properties that I owned not so far, actually it was my brother that owned it not so far away, that did not have a gas connection. And I can remember his bills for heating the house were so much greater than mine. Like, I used to just click a switch and the central heating would come on, and the gas central heating would heat the house up in a few minutes. For him, he had these electrical storage heaters with the bricks in them, and that would turn on at night and it would heat up, and then you had no control over it during the day. And I can remember his bills were like at least twice, if not three times, my bills. So massive problems there. So you want to make sure you have gas. I can remember inquiring about, can we get gas to the house? So it would be much cheaper. And on board Gosh, the gas company, they had a look at it and they said that, well, no, we're not going to go and build that trench. They had to dig a trench to put the pipe down, and it had to go something like 200 meters. And they weren't prepared to pay for that themselves, because there wasn't enough houses that they were going to service that. And so they said that we would have to fund it. And so there was like maybe 11 people that would have to fund this big long trench. And I think the total cost of it was going to be in the region of 5,000 per household. And it might have been worth it, but a few people just said no chance. And so next minute, the unit price went up for everyone else. So forget it. So when you're looking at land, you got to be thinking about all of the servicing aspects. That's the first thing. And then what you have to do is think about the neighbors and the potential objections that you're going to face. And I've had situations where I've had really, really good planning outcomes. I've met with the neighbors. I bought a property. I went into the next door neighbor on both sides and across the road, and I just sat down with them, showed them the plans. They weren't overly ambitious plans. First of all, it was a fairly normal extension to the house. And so they didn't feel like that they were going to be overlooked or any of that. Like, use your wisdom. If somebody is sitting in a house and they have their bedroom window is looking out over a green field, and they've had that view for years, and you're talking about plonking a load of houses in, looking back at them, then expect objections. But you can be kind of sensible about it. You can sort of position trees and stuff so that they don't lose their privacy, whatever. There can be ways to kind of deal with it, but you have to sit down with the people and explain it to them and say, look, here's what I would like to do. We made sure that we didn't overlook you here, and we did this so that you don't suffer from any losses there. And a lot of the time they'll say, you know what, everything's grand. We trust you. Go ahead, lodge your planning, and you don't get any objections. But I bought a property on Pierce Street with a couple of other guys, and we ended up years. Like I think we had to go for planning 3 times, and we were turned down every time, because the local residents were dead set against it. And in the end, we got planning for something that was so small in terms of like what we had initially planned that it didn't make sense to do it. We had a situation where it just wasn't economic anymore. The market had fallen and things like that. I see, John, I see your message in there. So I'll get to that now after I finished these questions that are in the school group. So, Niall, I hope that answered your question. If not, put in a comment there, and I'll get to it maybe next week. We have a question from Michael, and he saw investment land with planning permission for 14 apartments, 2 small blocks in a very good location. I know roughly what each unit would sell at, but working out cost per square meter to build apartments is what I'm struggling with in the current market. I know cost is a lot higher than a house, and high-level deals look like there's plenty of margin. Well, I don't know the question there, Michael, but for sure, apartments are far more expensive to build than houses. And one of the biggest costs with building apartments, it depends on the design and the layout and stuff like that. But sometimes people try to put in like a basement. Basement adds like huge costs. So forget about a basement. Try to get your parking around the perimeter of the apartment building. And at least that way, there is some chance of you keeping a lid on your costs. But for example, an apartment building, if it's any height at all, you're going to have to put in lifts. And if you're putting in lifts, a single lift, I know I've just replaced some lifts lately, but you're talking around about 80,000 to put in just the equipment that goes in the lift shaft. But of course, if you're building it from scratch, you have to build a lift shaft too, which is a big concrete bunker effectively. And so there is a lot of cost that goes in to putting in. And if it's a couple of apartments, usually the planners, they insist that there's not big long corridors between the lifts, like that the lift door opens and there's only 1 or 2 or 3 maybe apartments with doors off of that lift lobby. And so it can get very, very expensive. And a lot of the time it just doesn't make sense. It's just not economical. If we were doing something, what we're probably going to do is build houses first before we think about the next thing after houses is duplexes. And you can do duplexes where you build, we'll say like an apartment level on the ground, and then you have steps going up. And on the first floor level, that's your whole door for the duplex, and it goes up to the floor above. So it's effectively a 3-story building, and it's maybe a 2-bed apartment on the ground floor, and then 3-bedroom duplex on the floor, the second and the first and second floor above that. Hopefully that's helpful. We'll see now. Paul had a question regarding joint venture equity developments. So I'm going to simplify this just because when you're looking at buying a property, like if you don't have the money, what often you have to do is you have to go and partner up with somebody. And so if you're, say, what a lot of people will be thinking is that they would like to get into, if you're in the trade, we'll say if you work in construction, you'll have a lot of friends that are capable of helping you out. And all of that stuff can basically mean that you're in a position to possibly build this property yourself. And so you're going to think to yourself, I can go and do a bit of development. But the problem is perhaps it costs more money than you have. And so you have to go out and you have to try to find somebody to help you with the funding of that. And so what I have found is going out there and getting partners involved. This is something that I teach in my accelerator, like how to raise money from partners and stuff. And that is a slow process because, first of all, if you're doing something for the very first time, then you're up against it, because doing something for the first time means that you don't necessarily know what you're doing. Like, you're we'll say, kind of uncharted territory. You don't have a track record doing this. And so for the vast majority of sophisticated investors, they'll run a mile from somebody who's learning the ropes. You might go and get, family and friends and people involved and stuff like that. And that can work. But you just need to be careful, because you're embarking on something that's fresh and new, and therefore there's a learning curve. The way it can work in terms of the way you split it and things like that is that, you're putting so much money in yourself. Maybe you've paid for some of the site. You need somebody to come in and help you buy another piece of the site. So you combine your money together and you create a company, and the company buys the land. And so the land is there. Now you have the land, but now you have to go and you have to fund the planning permission. You have to apply for planning permission. So there's going to be a certain cost. You both have to kind of co-fund that. And then you'll get your planning result. The planning result might say you now have planning to build so many apartments. What that can do is push up the price of the land. So now you actually have some equity between you and your partner that you have joined up and done. You're jointly sharing in that increase in equity. That can help you, because you can now go to the bank perhaps, and they might lend you some of the money based on that increase in equity. But the likelihood is you'll have to put more money in. Now the question is, what is the split of, the jobs that you're doing? Like, or if somebody is just putting money into the deal and is only a passive investor, like they have no role at all, like they're not helping with anything and stuff like that, then it's a little bit easier, because they're just a passive investor. You can offer them maybe a fixed return. You can say, look, I will pay, if that person has, we'll say 50,000 and it's sitting in the bank, they're making almost nothing in terms of interest on that. And so they might say, I'd rather give it to you. You put it into this development. You'll make some money on the development. You can pay me maybe 10% a year interest on that, on the money that I'm giving you. And that might seem like a fair split. But what other people will want is, if the deal looks like it's going to be very profitable, they might say, no, I want to be 50-50 in the deal with you. If that's the case, then what you probably want to do is charge fees of some sort for your role in running the deal. Like, it isn't, like, if one party is doing nothing and just putting money in, and if you're also matching that amount of money, the two of you have a 50-50 stake, but you're the one who's running around doing all the work. Clearly, you're doing work on this project. You're helping to realize it, and therefore you need to be compensated for that work. Now, if you have a construction company, maybe the way you get compensated is that entity that you are a 50% shareholder in pays your company for the job that you do. And so you're having to pay 50% to yourself, to your own business, we'll say, but at least somebody else is also paying. So you might have a bit of profit built into that. But a lot of the stuff that I did in the past, I charged fees for being the guy that was managing the deal. So if I found the property, I would charge like we'll say an acquisition fee. And that was, we buy the property. Let's say you buy something for 100,000. You might sort of put in that you get 3.5% of that. So 3.5 grand. That's your road. That's what you get paid for being part of the process of buying that land, for finding it, for the process of getting planning permission. Oh, now it was on mute. Can you guys hear me okay? I don't know how that happened. Anyway, we're going to get on to the next bit. In terms of this property, so let's say it's risen in value and good stuff. Okay, we're back on sound. Let's say the property has risen in value, and in the process of rising in value, let's say it's gone from 100 to 200. Now your equity has gone from 50 to 150. So that's a pretty decent position to be in. You've got some decent money locked up in this property, and you want to access that. And this is a natural thing. A lot of people want to do that. The first thing you can do is go to your own bank. So you've got the 50,000 mortgage with AIB. You go to them and you say, hi, I'd like to refinance the property. It's gone up in value. When we bought it at 100,000, we had 50,000 of a mortgage. Now it's gone up to 200,000. Can I refinance that? And can I get an additional, let's say, 50,000? The bank will probably just do that, because it's a pretty low level of borrowing. If you're looking at 50,000, a 50% loan to value borrowing rate, nobody's going to be too concerned about that in the banks. The problem, we're going to, let me see, sorry guys, I'm trying to keep my TikTok live going. The banks are okay. 50% is conservative. Nobody worries about 50% equity, 50% loan. But then if you're buying the house in your personal name for your home, the banks will allow you up to 90%. So to use the figure of 200,000, that would mean that you could have 20 grand of equity in that, and you could borrow 180,000 on the back of the property, as long as you have the ability to fund that. And the way it works is that people have to prove, with bank statements and stuff, that they have the ability to fund the interest on 180 grand, the interest in capital. Now, if it's an investment property, the banks tend to max that percentage out at 70. And so you need to keep 30% in the deal. And so do the maths there. On a 200,000 value property, that's going to be 60 grand that you need to keep in the deal. And the bank will allow you to borrow with, say, 140,000 in terms of debt. But if your original mortgage was only 50, then that's another 90,000 that you're able to get out. If you go to if you had your loan with AIB, makes sense to go to them and just to seek them to give you that money. The likelihood is if it's reasonably well financed, if it's not like over leveraged and stuff like that, they'll give you the money pretty easily. But sometimes they can be a little bit conservative, and they might say, well, what do you want to do with the money? And you might say, well, I want to buy this other property. And you start getting into, they have to kind of get credit committee approval for all this kind of stuff. Sometimes what it's easier to do is go to another bank. We'll say like Bank of Ireland or something. Go to them and say, I would like to refinance with you guys instead. I'd like you to take out AIB. Because that's a brand new conversation, it's possibly going to be easier. Now, there is a little bit more transaction cost involved, because the bank are going to need to have the title deeds and all that transferred across. So there's probably a lawyer involved and things like that. But generally speaking, it's not that difficult to do. That's the best way to go about it. Now, another way is to go out and try to finance it, like to keep your 50 grand mortgage and go to some other bank to try to finance out the equity. That's not as easy to do. And I'll tell you why. Because banks, first of all, they bring in restrictions that nowadays that there can be no second charge on the property. So if a bank gives you 50,000 on a mortgage, they will give it to you on the basis that they are the only provider of the debt and they have the title deeds for that property. And they will, a lot of the time, I've seen it now, that they have a restriction, and it means that there is no second charge. They will not allow another lender to come along, and they get first charge at the 50 grand, but anything above that is a second charge. They don't even allow you to have a second charge. So that's their way of restricting other people coming in. And so that's the first thing to remember. So if you wanted to borrow from another bank and they're not going to get a second charge, then the likelihood is they just simply won't do that. And the reason they won't do that is because there's no security there for them. Like, you could stop paying them interest and things like that, and they can't automatically get the property to repay their loan because the property is secured by the first bank. That second bank will come along and they'll have to like pursue you in the courts and stuff to try to get their money back. It's not simple. So that is unlikely to work as a method of financing. What people sometimes do is they go and they think, I want to go and refinance my property and I know it's gone up in value. You need to go into the bank, though, armed with information and data. Like, the bank don't just lend you money based on what you want. They will send in valuers. They'll send in all that stuff. And the valuers are going to want to know exactly what the property is worth. And they do that based on other properties in that area. So let's say you're on a certain street and 3 other properties have sold in the last 12 to 18 months on that street. The valuers will look at those properties and they will look at them and they say, okay, there is a fair estimate of what the value of this property on this street is. And you might have reasons, like you might have a better house or you might have a slightly less, like it might be a smaller house or whatever. Those are all reasons for the bank to tweak the value, maybe up or down slightly, but it's not going to be dramatically different. And you need to make sure that you know this going in. The guys that are going in and looking at the buy, the buy, refurb, the refinance, it's rent and then refinance. The B or model is buy, refurb, rent, refinance, and then recycle the money and go and do it again. If you're going to go and do that, you really have to be careful, because what happens is people they might put in a certain amount of like 50,000 in and they're hoping to get that back out. But unless you've done your homework and unless you've gone up and down the street and understand what are people paying for property on this street and what is the likelihood that the bank will support the value that I need to get my money back. And so there's a little bit of homework needs to be done. And if you need any further information on that, send me a message and I'll clarify it. I'm going to go into that. By the way, that goes for both investment and personal property. The only difference between investment and personal property generally is that when it's your personal property, they let you go up to 90% loan. And, you have to be able to support the mortgage based on your salary or however you make your income. And people who are self-employed struggle with that, because if you're a person whose income fluctuates because depends on how business is doing, then it can be difficult to go and get a loan on that. Whereas if you're paid a salary and it's the same every month, then the guys in the bank, they have visibility on that. They can see, okay, this person collects X every year or every month, and therefore we know that he can cover the mortgage. When you're buying their investment property, they still are looking at your ability to service the loan. And so that is important, but they'll also be considering the fact that you're going to be renting it out. And so there will be probably that additional rental income coming in as well. But they don't necessarily give you the benefit of the doubt that the rental income is guaranteed. There is a question here from Adnan. And he asks, what's the best strategy for a first-time buyer because there's so many opinions out there, with some stating, don't go near mortgages if you can't pay it within 15 years, fixed interest. Borrower is a slave to the lender. I have no faith in the banks with variable interest rates, burning part of your salary. And then he says, I think you kind of answered it with your first question. So the thing is like property, it all depends. Like, you have to look at, I always looked at property as something that is dynamic. Like, I see a property, I like it, I see myself as being able to add value to it. I would like the idea of improving the property. Like if you go and buy a property that's in, we'll say, poor condition, tapi it was owned by an elderly lady who lived there, or maybe she went into a nursing home and so she didn't live there for the last 10 years, but she never sold the property. So it's been unlived in for years. Those are called executor sales. Those can be a good way to buy a property that's in poor condition. But the property will need a fair bit of work. Like it'll probably need a new kitchen and new bathrooms. And if you put in a new kitchen and new bathrooms, that can make such a difference to how the place looks. Apart from that, like carpets and painting and stuff, that's not difficult. Nowadays, you also need to be thinking about the energy performance of the building. One of the things that's starting to come into focus by a lot of the banks is just what is the BER of the property. And if the BER is low, like if it's a really bad one, like a G or a D or something like that, those older properties tend to have those bad. The banks are less inclined, less interested in that. Whereas if you are like this house, I've just moved into this new house that we built, and it's an A1 rated property. And like you can't get any better than that in terms of energy performance. So my bills are very low, all that. But what's interesting is that the bank, like they love the idea of financing a property that's an A1. And why is that? It's because the bank have loan books, and they'll have thousands and thousands of people, customers that have a mortgage. And those are loan books filled with borrowers. And if the loan book has a majority of, we'll say, A and B rated property, then that looks like a very sustainable, green, friendly to the environment loan book. And that gives the bank sort of like kudos, but also it means that their loan is kind of future proofed against climate change and things like that. Whereas if they've got loads of properties in there that are all old dated properties, it could well be that it could be that they just won't finance that in a couple of years' time. And so if you're doing up a property, have a think about the energy performance. Things like, insulation, windows, improvements to the central heating system. Nowadays, it shouldn't be gas. It should be heat pumps and all that kind of stuff. Solar panels on the roof. All of that contributes towards getting a better BER, and that you can actually get lower interest rate loans. I've seen the banks are charging, the last time I looked at it, which was a while back, was 0.5% lower if your property is an A1 or an A2 rated property, BER. The bank will give you 0.5% off your mortgage compared to other customers with a different property. So there you go, Adnan. Like I see property as dynamic. Like I see myself as buying the property, do it up, maybe sell it, maybe rent it. I don't see myself as being stuck in it for the next 15. I can sell it. Hopefully the market will be rising in the meantime. When I buy something, I would buy something that I can see that I can personally add value to. I wouldn't buy an apartment. This is going to be interesting for some of you to hear. Like, do you buy an apartment or do you buy a house? Personally, I would buy a house because I can add value to a house. Whereas with an apartment, if you buy an apartment, you have to share the staircase, you have to share the lift, you have to share all these things with all these other people. You can't add value to that. You're stuck with it. So if you have a beautiful property, you've gone and replaced all your carpets, tiled all your bathrooms, replaced your kitchen, everything like that. You've done everything to your property. So you get the maximum value for that property. And then the purchaser, on the day of, you're putting it on the market for sale, the purchasers arrive to go and view your beautiful property that you've spent so much time and effort on. They walk into the lobby and one of your neighbors had a night out and vomited all over the lift. Do you think they're going to be interested in that property? Like, that's the bit that drives me mad about any kind of shared facilities, things like that. You don't have control over it. Second of all, you can't extend an apartment. Like, you might be able to rearrange internally the way the furniture is and things like that. But generally speaking, you can't add another bedroom by extending out into the garden or anything like that. With a house, there's an ability to add value. And that is one of the reasons why I'll always choose a house over an apartment. Now, apartments are great insofar as you're in the city center and stuff. But if you want to buy a property that is just going to be a property that is, you buy it ready to go and you just want to collect rent and you're not looking to increase your equity by adding value or anything like that, well, that's a slightly different story. But a lot of people, they want to kind of grow the value of the property, and you'll struggle to do that with an apartment, in my opinion. All right, John has a question. What would you think about using the vacant property grant to get started in buy-to-lets? I know you can't sell for 10 years your money. Well, I don't know a huge amount about it, but I have heard guys talking about it inside the thing. And the reality is that the vacant property grant, like, it'll cover so much, but a lot of the time, if a property is vacant, a lot of the time it's because it's in poor condition or something like that. It's, if a property can be rented in this market, generally speaking, it is rented. If it's vacant and nobody wants it, a lot of the time there's a reason for that. And when you go in and decide, okay, I'll get the grant and I'll go and do the work on it or whatever, a lot of the time the grants only cover a certain amount. I mean, if you look at people that are looking at improving the BERs on property, they will go and they will find that, you can get so much of a grant for putting solar panels on the roof. You can get a grant for replacing your central heating with a heat pump. You can get a grant for new windows and all sorts of stuff. And it's great, free money. But it doesn't pay for the work to be done. It covers like a percentage of it. And so it's nice to get that free money. But the reality is like, if you get, we'll say 14, 15 grand in grants from these guys, you might have to spend 30. Now, I don't know exactly the figures, but the last time I spoke to somebody, that was the kind of ballpark that he was talking about. And so do you have the 15 or 16 yourself? And another thing about the grants I've heard is that you need to be approved before you take any action. And so sometimes that's just not viable. So if you decide that you want to get the vacant property grant, you need to apply for it, and you need to apply for it before you do any of the works and things like that. So you might be waiting to hear. And if you're thinking of buying a property, you might want to know that you've got the grant before you actually go ahead with it. So you need to look at the logistics of all this kind of stuff. All right, so I've done all the questions that are in school, and I've done all the questions here. I'm going to start going through a couple of questions, and we're going to get near the end here. Let's have a look. There's very few questions in the Instagram. Sound is fine. Oh yeah, that was the guys in the YouTube that were saying the sound is bad. Okay, Irish based in London. Are the banks starting to lend again in Ireland? No, they are lending, of course, but it's nothing like the ease of borrowing that you have in the UK. The banks got so badly burnt in 2008 that they are just like they're gun shy, as you would say, about an animal or whatever. It's just the banks are just so difficult to get money out of. Like, they want how much deposit to put down for an investment property. You need to be putting down, in the Irish market, you need to be putting down about 30%. And so that is certainly the rate that most of the guys that are in my mastermind are talking about. That's what they're basing their numbers on. If you're buying it for yourself as a residential property, then you'll go as high as 90%, provided you have the ability to service it, and you have to prove to the bank and stuff like that. Best auction website besides BidX1. Like, I don't know. There's not that many auction websites out there. I usually just follow the papers, and like, the best deals, in my opinion, are ones that are not anywhere, that you have to go out and actually ferret out the deal yourself. I have found that, if you are buying a property that you're bidding against other people for, then the price is just going to go too high. Especially in this market, it's so hot at the moment. And it's hot because there's thousands of people trying to get a home, and there's so few properties going up for sale, and therefore it can be very, very difficult to get it at a decent price. And you'll probably just find that the vast majority of people, you go in to bid on a property. If you're an investor, you'd be saying, okay, I need to achieve so much of a yield. My yield is, I have to be able to cover my payments. And because you're an investor, you're putting 30%. And so that there's a substantial sum has to go down, and therefore you want to make sure you're getting a decent return. But for the person who is buying it for their family home, they're not thinking about a rental yield. They're not thinking about all that. They're just thinking about, this is our forever home. This is where the kids are going to grow up. That's the kind of mindset that you're up against. And so an investor who's logical, rational, thinking about all this stuff very carefully and looking at numbers, versus a person who's making an emotional purchase for a family home or something, you don't really stand a chance bidding against somebody like that in this market, because the investment rationale is kind of gone. You're up against somebody who's buying emotionally, and an emotional purchaser will always pay more than a rational investment-based kind of offer is the other one. Yeah, that's true. Looking now in, let's see, Brendan has a comment here. Can you buy a property if you have 2 or more mortgage-free properties as a guarantee? Yes, Brendan, that is something. It's funny, I got a question very similar to this a couple of days ago. And like, if you have property that is unencumbered by debt or anything like that is equity. And so that you can go to a bank and you can say, I have these 2 properties. They're worth 100,000 each, whatever it might be. So that's 200 grand of equity that you have there. The banks will be happy to use that as collateral, provided they're in the country. If you, like, I've seen people looking at, will say, I have a property in Spain, and people will look at property in Spain and say, oh, I'd love to have that. But the banks in Ireland won't look at that as collateral, because for them, they can't get access to that. And so they'll only be looking at property in the state as collateral. And so that's one of the things to kind of think about. The next thing is, so your question was, can you get, so just go to a bank, make sure it's in the state so that they're interested in it, and just go to the bank and just sort of say, I'd like to, borrow some money to buy some property. I have some collateral here. Now, just be aware, this is one of the biggest problems with doing this, is that the property that you buy, if you buy well and you're getting a nice rent and all that, then everything is good. But if you buy badly and something doesn't really work, if something doesn't really work, like the tenants stop paying the rent or something like that, and you're unable to finance the mortgage, then they will go after, they'll sell the property on you, and any shortfall that's left on that loan, they'll go after you against your collateral that you used. So you want to just make sure that you're aware that if it goes pear-shaped on you, they'll be after those unencumbered assets, and they'll be looking for those. And so just tread carefully. And I'm sure you're well aware of that, but I'm just wanted to kind of point it out. Do you think property prices will drop, considering wages aren't rising at the same? I personally don't. And if you go back, like if you guys that are looking live here on TikTok or live on Instagram, the reality, I'm recording this over in my YouTube channel, and you can watch back to the beginning, but I actually went through maybe 20-minute talk on why I believe prices are not going to fall. And I've seen people asking me the question, should I wait for the market to kind of crash and then buy in? And of course, that might be that's an interesting idea, but it's unlikely, in my opinion. Like, you can have your own opinion and stuff like that, but the reality is that the supply is constrained by the construction sector capacity, and demand is insatiable. And today in the newspaper, the Central Statistics Office are predicting that the population could increase as high as 7 million by 2057 or something like that. And so in a generation, there will be 7 million people living in Ireland. So we're just not going to be able to build enough houses to get demand down for that reason. And so you're asking now specifically about mortgage rate. Like, the only reason that I can see what will happen is, it's not so much that prices will fall, but what will happen is that the affordability is, I would imagine that people still need a home. If they cannot afford a home, they'll just go further and further out. So instead of buying, 5 miles from where you work, you might end up buying 25 miles from where you work. And so you end up on the commuter belt, driving longer and longer distances to get to and from. But there you can afford those properties. And that is unfortunately the reality that we're seeing these days. And I think, I know that, there's guys, in fact, we've looked at sites as far as Drogheda now, because that's the commuter belt. That's where people are driving. So that's a question there. Do you think, can you use a personal loan to buy a house and then refinance to do it up? It's all about the equity. If you buy the house with a loan, like as your home, and you get 90% and you have 10% of equity, the likelihood is you're not going to get any more equity out of the bank, because at that stage, like you're quite heavily leveraged. But if you bought the property and you bought a property with only 50% leverage, well, then that's easy enough. You've got 50% of equity in the deal, then it's quite possible that the bank will be comfortable with that. But they're not going to be comfortable doing it if you're already heavily leveraged. All right, guys, look at the time, 9 o'clock. I think I'm going to close it, call it a day. I'm going to start doing this every week, 7:30. I've been here since 7:30. It's now 9 o'clock, an hour and a half chatting with you guys. Hope you enjoyed it. If you have any questions, join my school group. You'll find it in the bio. School community. It's a free community. You can join, and then every week I'm going to have just an area that you can drop a question in, and I will deal with the questions in school first before I deal with the questions in the chat here. So talk to you soon, guys. I hope you have a good one, and I hope you found this one good. Take care. How do I turn off all this stuff?